Here, I'll share my screen next. You guys see this?
Yes.
Are you
Yeah,
guys
that's
able
fine.
to-
Yep.
Sweet. Awesome. So I'll be presenting about a protocol called KINE. And full disclosure, the fund that I work at invested into KINE, and I personally hold KINE tokens as well. This is not investment advice. I'm just a huge fan of this protocol. So yeah, without further ado, KINE is a permissionless peer-to-pool marketplace with cross-margin leverage, synthetic funding, and multi-collateral functionality. And that does sound like a lot, but I'll go into each part of that to really dig into what this protocol actually does. So it offers instant liquidity by like allowing for people to convert between synthetic positions without slippage costs. I'll show more how it works when I share like the screenshots of the protocol, but on top of that, it uses synthetic funding in a way where all trades are executed by allowing for people to provide single asset staking. And in doing so, people are exposed to like protocol debt, and the protocol debt increases or decreases depending on whether or not traders using the protocol make or lose money. And synthetic funding allows for the protocol to cover some of that risk by taking the opposite exposure to trades done on the platform. But at the same time, the debt does creep up a little bit. And I'll go into that more later as well. Multi-asset exposure. So as I mentioned before, like KINE is a peer-to-pool marketplace, which basically means that for anything that has an oracle or a price feed will be able to be traded on this exchange. So not only like crypto or not only like synthetic stocks or things like that, but also potentially like derivatives or all sorts of other assets as well. And it's really going towards being a permissionless for the best in slot permissionless version of like a centralized exchange. It also allows for cross margin for up to 100x leverage on long and short positions, which is probably the highest leverage multiple that exists in crypto right now, given centralized exchanges have been like increasingly limited to like 20 times leverage at the greatest. And so this is definitely pretty interesting infrastructure given that it exists. So how does peer-to-pool work? So all trades are executed at real-time prices by basically looking at different order books or exchanges across the market to see like what the real price of different assets is using like a weighted average. And the staked assets within the protocol are used to like fulfill trades at those prices that are provided by oracles. And so you don't get any slippage costs or anything like that, which you typically see within decentralized exchanges, which is also why decentralized exchanges are, not a super favorable option for things like, bigger funds or larger trading desks that execute a lot of trades. But with the peer-to-pool model, this may be a more attractive option for these sorts of players. And stakers do bear inventory risk. So if you are staking, you have protocol debt exposure, which allows for you to, borrow up to 80% against the assets that you stake. But at the same time, the debt can fluctuate and go up. And while the debt may go up and you may be wondering, then why would I borrow against my assets? Well, you get like rewarded with KINE tokens. And the reason why KINE tokens could be valuable is that KINE tokens are rewarded with the trading fees, a portion of the trading fees that are realized by the exchange. So in summary, the traders enjoy zero slippage and one-stop market exposure. Kind of like putting this into something that is easier to visualize. So we have traders, stakers on the left and right. So if traders trade on the exchange, have some positions and receive losses, then the debt that everyone shares by like providing assets to KINE protocol, it decreases. And the stakers' debt, essentially, like if they were to pay it all off, they would have impermanent gains. Whereas if traders have trading gains, then the debt price would increase and the stakers would have impermanent losses. That being said, once traders trade with the global liquidity pool, part of the trading fees go towards those stakers. So it makes it worthwhile for them to stake their assets as well. On top of that, there are token rewards for trading on KINE's decentralized exchange. So depending on your trading volume, you could be mining KINE tokens. Also, you can like mine KINE tokens by borrowing against your assets as well. And pool liquidity makes it easier to trade on any sort of asset that has an oracle that can dictate price feeds from alternative exchanges, which may become a problem maybe someday in the future if every exchange starts using peer-to-pool models and looking at each other's order books for accurate pricing. Then maybe we can have a circular reference across the market. But given that peer-to-pool is only really done by a couple of different players within the decentralized exchange space, I don't see this being an issue right now. So I can move into the next part. Here's a screenshot of what the staking interface looks like. So as you can see, there are like available assets at the bottom over there, which have different APYs. The APYs are realized by borrowing against those assets. And so for stable coins, for example, if you were to borrow up to 80% against them, you can use that borrowed money to trade on KINE'S Exchange and like basically mine tokens by borrowing and also mine tokens by trading using borrowed capital. The debt could still fluctuate given that protocol debt moves depending on whether or not traders on KINE'S Exchange make or lose money, and whether or not all of that exposure is very well offset by the offset mechanisms that KINE has built in. But if you were Ethereum BTC or like KINE or any sorts of other tokens that aren't stable coins, then if the price of the token were to drop such that you have over 100% debt, you would start to get liquidated. And then this is what the protocol's exposure typically looks like. So there's a page to like review the different like exposure that you have to each underlying asset. So as you can see over here, the protocol has like a negative 50K position in ADA. It has like a position in Ethereum, a position in BTC, and it works to offset these positions as best they can to try to reduce protocol debt from moving around too much. But you can definitely see what you have exposure to through that protocol debt as well. This is what the exchange looks like. So I mentioned earlier that it has cross margin, and what that means is you can basically cover your leverage across your margin accounts instead of just using isolated margin on the play that you're making initially. The way it does that is, while you can use like MetaMask to interact with like the staking of the protocol, in order to trade on the exchange, you deposit into another address that you can use to trade on the exchange. And then you can't withdraw if you have an open position or anything like that, to basically ensure that you can use leverage in a decentralized way. They do have like several trading pairs. I have a slide afterwards that goes into exactly how much, but it's a pretty interesting experience. And as I mentioned, also, you can mine protocol tokens by trading on the exchange to incentivize more volume as well. So here's what KINE looks like so far. It launched in around March of this year. All-time volume updated for July of this year is around 10 billion so far. And the fees collected every 30 days is sitting around $1.2 million right now. The TVL is at 35 mil. The highest volume the exchange has ever seen so far is $300 million. And it has around 6,500 daily traders. And I think this is where the real meat comes in. A lot of these different data points haven't been up to date since the end of July, because this is some research that I've done 2 months ago. But I did update things like the monthly volume and the market cap as well, just to give you a better sense of what's going on. So while KINE's peer-to-pool and Oracle feeds like model for price feeds is unique and efficient, Synthetics actually uses a similar model as well for their price feeds. If you compare the different exchanges, KINE has a lot of users. DYDX probably has a lot more users right now, given that they released a token and like greatly incentivize usage on their exchange. So those numbers aren't up to date right now, since DYDX has had quite a bit of changes over the past 2 months. But that being said, KINE's leverage is still, maximum leverage is still a lot higher than most other exchanges that are out there. And the trading fees are on the low end compared to what we see other players within the same space do. The monthly volume for KINE is actually extremely impressive. It's at $5.7 billion per month at the current trading volumes, which is actually higher than perpetual protocol and synthetics combined. And the reason why this is interesting is because the APYs that you receive by borrowing or staking on the platform are measured in KINE tokens, which are currently sitting at a $63 million market cap. But if you were to use multiples on monthly volumes or things like that to try to guesstimate, what a fair price could be for a protocol like this, if there were to be price appreciation such that the market cap would be more in line with multiples on monthly volume, then the APYs you can get for even staking stablecoins could be pretty lucrative, given that it wouldn't be like 30% right now or like 50% how it's been earlier this year. It'd probably be closer to the several 100% APYs. And so this is personally my favorite way of like staking USDC for semi no risk. You still get like obviously the debt exposure, and the debt does creep up. But that being said, the tokens that you get rewarded, even at this current market cap, definitely cover those losses. And if you were to see KINE appreciate in market cap, the APYs that you'd get even on stable coins is pretty ridiculous. So the token, it's used for governance for things like addition or removal of staking or trading assets. You can set different parameters or vote on parameters using the tokens as well. But also, in addition, you can use KINE to earn trading fees that are earned by the exchange. And on top of that, the more you stake KINE, the more governance power you have as well, if you really care about the protocol. So yeah, that's my presentation.